I have the pleasure of introducing my good friend, Dr. Jason Scott Earl. Jason and I go way back. We literally sat in class, setting like this 30 years ago. We were classmates. We both studied engineering as an undergrad and then went on to, it was one of those things where I got through my engineering and realized I knew nothing about like business and how things like companies and, things actually worked. And I saw those like punk sales guys over at the business school and, they seemed to have a good time. And we were like, studying weekends and I thought, well, I might as well like, instead of like complaining about it, I might as well join them because they seem to be having way more fun. So you're in the right place. It took me kind of a roundabout way to find my way here. And it's been a fun ride. But for, I just want to emphasize that, you are getting an education. Obviously, that's what you're paying for. That's what you're, spending your time doing here. But the relationships that you're building is as much, if not, of greater importance than your education. And again, it underscores, Jason and I, 30 years ago, we've stayed in touch. We've gone, on different paths. But we've been in different parts of the country. Sometimes, different parts of the world. But we've stayed in touch. We've done business together. We're now looking to do more business together. And so those relationships beyond, again, the formal training that really last and will help you open doors for jobs, open doors for again, career, business, and just general relationship opportunities. I know we live in a virtual world, but take the time to like get to know your classmates. So with that, again, I'm happy to introduce Jason. He is, this is a long list of accomplishments here. So I'll hit the highlights. Jason is a partner with Kipuka Advisors. That must be a Hawaiian name.
Yeah, it is.
And Jason has worked for Fortune 500 companies, ExxonMobil, fresh out of college. I tried to follow his footsteps there. I got an offer from them, but I didn't want to live in Houston. So I ended up going a different path. Jason has more degrees. Like I thought I was doing okay with 2 degrees. This guy has like 4, at least 4. A master's or undergrad degree, a bachelor's in engineering, a master's in structural engineering, an MBA, and a PhD. Those are the ones I know of. And he's been a professor. He's one of the rare, unique individuals that can teach and do. And sorry, I know we
It's okay.
You'll hear this joke if you haven't heard it already, that those that can't do teach. And I hate to even bring that up in this setting, but Jason is one that, again, unique individual that has done and can do both. And so you're getting this opportunity to hear from someone that's worked in private practice, that has worked with, built many businesses, successfully exited many of those. He's taught entrepreneurs. He's taught students in strategy and entrepreneurship. He was the director of the Entrepreneur Center at BYU Hawaii for a number of years. He worked at BYU Idaho. And so you've got a wealth of experience you're going to hear from today. So with that, I'll turn it over to Dr. Jason Scott Earl.
All right. Thank you.
If anyone should be presenting today, it should be Mark, but I appreciate his kind words. I want to let you know that wherever I go now, I say aloha, especially to my friends from Tahiti. There's something about a culture of love and respect where you feel like you can be open, people won't judge you, and you can actually trust each other. So I hope to share that with you today. The reason why I'm an expert on this subject is because I have 6 startups, and they are Benjamin, Jaden, Grant, McKenna, Max, and Henry, right? There's nothing more akin to entrepreneurship than having a baby because you invest in these little things, you think they're beautiful, other people tell you they're kind of ugly, you don't want to hear it, and you just pray for their future, right? We've got our 3rd IPO that just went out this last year. This is Jacob. They're not all babies. This is just pictures of when they were babies. But this was Jacob when he was a baby. He's in Korea now serving a mission. And I got to say, it's the most rewarding part of life to see these little guys grow up and go out and do new things. And I know your parents feel the same way about each of you. I want to start off with 2 case studies. Keep this interactive. About 10 years ago, 11 years ago now, the NASA made a significant investment in both companies. They invested in both SpaceX and Boeing. Any guess on the dollar amount? Where's Baden? Yeah. Just it's in the billions. Any guess how much they spent on these guys? $5 billion. Ooh, that's pretty close. Any others? I think between the two, that's pretty close. 2.6 plus 4.2, that's pretty close. All right, they spent half the money on SpaceX, almost twice as much on Boeing. And what did they get? Any guess on how many missions we've seen in the last 10 years? Okay. You got to raise your hands. You got to throw something out there. Yes? 0. No, we've seen some actual missions come out of this. There have been missions. How many missions? Any guesses? 10. 10's good. Yes? 2. It is between 2 and 10. First mission for SpaceX was in 2020. Boeing's was in 2024. As far as total missions, SpaceX has had 13, and Boeing has had 1. Actually, half of 1. Right? They got their astronauts like halfway there. So just from an investment perspective, think of how much money was spent and what has actually come out of this. If we break it down on a per astronaut basis, we can see on that investment, we had a total of 49 astronauts actually into space in orbit with SpaceX, 2 with Boeing. And guess what? These 2 are still there. They can't get back. So on $1 per astronaut, as far as return on investment, we spent $53 million per astronaut, $2.1 billion per astronaut with Boeing. Okay, any thoughts on this? Does this strike you as surprising, or is this just like another Elon story? So this is gonna be like a really long 30 minutes. Any thoughts?
Kind of surprising.
Kind of surprising? Why do you find it surprising?
Well, you spent $2.1 billion for 1 astronaut in Boeing,
Yeah.
and did you do one for like no one? I mean, it's kind of split cost with 49 people.
Yeah.
And I'd rather spend $53 million on 1 astronaut with SpaceX rather than $2.1 billion.
Yeah, great. Excellent point. Yes.
Isn't that right around when Boeing got a new CEO and their quality just kind of started going down?
Yeah, I mean, I think the engineers would say it happened probably like 10 years earlier, but yeah, what we saw happen was our leadership went from the floor space where manufacturing was happening, and they went to like the corporate office. And they actually, like their headquarters are in Chicago, and everything they produce, at least on a commercial basis, is out of Washington. So we've definitely seen some leadership issues, some quality issues. But if we go straight to the numbers, like these are the results. As far as the return on investment, SpaceX has basically dropped their cost per pound into space by 97%. Our results for Boeing, we've stranded 2 astronauts. What was supposed to be 8 days has turned into 8 months. Right? Like these are the results. The reason I bring this up with you and share this with you is I can't think of a better example of this choice you have in life between becoming an entrepreneur or becoming a bureaucrat. And I know Mark has seen a lot of these. These are people who hide out in their offices, they look at spreadsheets, they play the political game, they move blame around. And what we see really is the sign of the entrepreneur is actual results. Here we have lots of excuses. So if you take nothing away from my brief lecture today, I would just beg of you to make a conscious choice, right? Make that decision to be someone who actually gets results. These people that we have in these companies who achieve results, they're like jewels in a crown. Like you're searching for them, you're trying to find them, and when you do find them, they are worth so much. You can't pay these people enough. These are people, they have the ability, the tenacity to just get stuff done. Is that a phrase we can say? Get stuff done. All right, one more case study. I want to compare 2 companies, and I want you to tell me which one's more valuable. I pulled up the financials last night on Yahoo Finance. Yahoo's not good for a lot of things, but for financial results, they're amazing. This company last year did $145 billion in revenue. Worldwide, they have about 10,000 employees. On the Fortune 500, they're ranked number 40. In case you don't know, I just want to let you know, this is an elephant of a company, right? Mark's company that he took public last year is worth about $3 billion. $3 billion, this thing is like doing $144 billion just in revenue. If we compare that to a relative mouse of a company, during the same time period, they did $5 billion in revenue, about a third of the employees, and on the Fortune 500, they don't even show up. They're not even ranked. So if we go to market cap, which tells us the perceived value, how valuable these companies are, which company do you think is more valuable?
The first one.
The first one. Why do you say that?
It's making more money.
Right? It's making more money on a top line basis or on a profitability basis, do you think?
I think it's still more profitable.
Okay, you are correct in that. It is more profitable. Good. Other thoughts? Let's just do a quick poll. How many of us would say the elephant's more valuable? Show of hands. Okay, there's like a third. How many of us say the mouse is more valuable? Oh, good. Another third, and there's a third that's not voting. Okay. The second group would be correct. These two companies are Valero and Coinbase. The market cap, the perceived value of Valero by investors is $43 billion. Market cap for Coinbase, $70 billion. So think about that for a minute. How could a company with a fraction of the revenue be worth 50% more? Yes?
Are they able to do more with less? They have like a third of the employees that the company does.
Yeah, they may be able to do more, but I mean, they're not doing much more in revenue. Like they're doing a lot less in revenue. Yes?
Is it projected value for what they could be worth if they keep up their pace?
Okay, good. Projected value. Why do we talk about projected value when it comes to market cap? How do we even calculate market cap? Any thoughts on this? Mark, do you want to tell us?
It's a multiple of, kind of your next 12 months projected revenue.
Okay.
So, and the multiple depends on, how much upside, potential, and growth.
Okay. So for whatever reason, this is all about potential, growth, future upside. This is what people think about the future of the company. So all we have to do is take the stock price times the number of shares outstanding, boom. And for whatever reason, investors believe in Coinbase. What does Coinbase do? Crypto, yeah. These are our kings of exchange and crypto, all things Doge and I guess Melania now, all things crazy. Wait, we'll edit that from the video. So, why do people, but what does Valero do? Why does the market think so poorly of them? Yes, this is oil and gas. So for whatever reason, investors think the future of cryptocurrency is huge. The future of oil and gas, not so great. Now, the reason why I share this with you is there's a huge correlation between what people think of companies and what people think of individuals. And I'll just say right now, your revenue is probably not that great. Your net worth, your total fixed assets, probably not that good. But the reason why someone like Mark or I would invest in you is because of your future potential. And that's why I love these little colleges in the middle of nowhere, like Ephraim, Utah, because I'm telling you, this is where future gold is. These are people who are willing to work hard, think differently, find opportunities. And in many ways, this is why valuations come in so high compared to, other places. Any thoughts on that? Okay, what I want to share with you briefly now, if you're going through these case studies, is what we teach at BYU Hawaii. We really focused on 3 things when it came to our Entrepreneurship Center. We wanted our students to learn how to learn how to make money, and learn how to live a life of meaning. And what seemed to attract our students was the money. Like, oh yeah, I want to learn how to make money. But the interesting thing about education is whatever you learn over the next couple of years here is going to be completely obsolete. In fact, it's probably too late. It's probably already obsolete. But the fact that you've learned how to learn, this is what's going to give you a future. And over the last 15 years, watching my students come back to the classroom or connect with them again, this has been what's been most valuable to them. Like, not the learning, not the money, but to know that they've lived a life of meaning. There's actually like purpose to their life. So what we really try to focus on with our students and their future needs is a list of things. They need to know the myths, they need strategy, they need a mentor, they need a team, they need a purpose, and they need to know about disruption. Because we only have 20 minutes left, I can only talk about one of these things. I would love to be here and talk about all of them, but I want to talk briefly about the myths of entrepreneurship because there's a lot of them. The reason why you need to know the myths is because there's a fact out there. If you don't build your own dreams, someone's going to hire you and build theirs, right? This is what Mark alluded to with seeing those like business guys in this fancy Tanner building. I think we used to call it the glass box that the Salt Lake Temple came in. That's not what it was. Anyway, if you don't get control of your destiny, this is going to happen to you. And I want you to know, getting a job is great. Working for the man is fine. But you should be working on your own ideas. Like somewhere in the back of your mind, you should be like boiling something, having something percolate. Because you could learn a lot about the industry, about the opportunities. And when the time is right, you need to be ready to strike out. Ready to do your own thing. And there's no better time than where you're at right now. You guys don't have to worry about huge risks and mortgages and kids and, well, maybe some of you with kids, but I would really be thinking about what can you learn now so that you can go out and build your own future. So myth number one, entrepreneurship is not about waving money in front of people or the classic putting cash underneath someone's chair. No, it's not under the chair. They would say, I know what it was. They would hold up this $100 bill and they'd be like, who wants this? And then they would like wait for some student to come up and just take it out of their hand. And they would say, that's entrepreneurship. And I'm here to say that's not entrepreneurship. That's called stealing, right? So the truth is, entrepreneurship is about a discipline of gaining business knowledge and business acumen over time. It's getting really good at something, finding an opportunity, and then going after it. Also, you should know there's nothing more dangerous than an entrepreneur after their first success. This is typically because they learned all the wrong lessons, they got really lucky, and now they want everyone to know about it. When we ran a simulation at BYU, we could measure both business knowledge and business acumen. And it was really interesting to see how these could be increased over time. If I was to give a metaphor, the business knowledge is kind of like going to an aerospace engineer and you ask the question, where's the spoiler and what does it do? And a good aerospace engineer could tell you exactly where it is on the plane. They talk about Bernoulli's equation. They talk about lift. They could totally describe it. Likewise, a business knowledge question might be, what is return on invested capital and how do you calculate it? We could basically go to net income over total invested capital. We know the theory. We can totally explain it. But that's very different than dropping you into the cockpit at 10,000 feet and saying, okay, you're now in a flat spin. You only have 3 controls. What do you do? Right? This is all about the acumen, knowing what you actually have to do. This is part of the reason why I love business simulations. We could set you up where your return on equity is below 5%. It's dropping radically. Do you issue dividends? Do you pay off debt? Do you raise more money? You've only got a few levers, but you've also got limited time. And actually being able to do it is very, very different than being able to talk about it. Any comments on this? Right. Okay. Myth number 2, entrepreneurs take risk. This is a terrible, terrible saying. This is totally not true. Entrepreneurs don't take risk, they manage it. Now on the surface, it could look extremely risky, but they've found ways to basically mitigate the risk, to take it off the table or push it onto other parties in order to increase value. And personally, there are some things that you should never risk. Your family, your faith, your friendships, like these are sacred. These are things we don't mess with. Another myth is the higher the risk, the greater the reward. The truth is entrepreneurs find ways to dramatically bend this risk reward curve. If I only had like 10 minutes with my students for an entire semester, this is the one thing I would talk about. And I think the way to explain it is if you look at risk and value, they're inversely proportional. So over time, most startups fail. 80% of all startups fail after 5 years. But if you can somehow, if this is time here, if you can somehow make it this far to 5 years, what's happened is you've found ways to eliminate risk, whether it's market risk, financial risk, people risk, and at the same time, you've increased value. And the problem is we don't have time to wait. We can't just like wait 5 years for our venture to fail. So we need to go in and we need to identify the deal killer risk. These are the critical risks, things that we could eliminate early. And what that does is it drops the risk. So as risk goes down, value goes way up. So if we were to pick a point in time, say right here on this chart, we can see relatively high risk, low value. But if we eliminate those risks, at the same time period, we see just the opposite, relatively high value and low risk. And this is exactly why big companies like successful startups, because the startups have done all this work to eliminate risk, show there's an opportunity, then they can come in, pay a premium, right, and grab it, but also capture that future value. Okay, you guys should have lots of questions about this chart. What questions do you have? Yes.
What does it actually look like to mitigate risk?
I think find something that could destroy the future of the company and get rid of it. We'll use the Netflix example because it's up here. When they were competing with Blockbuster back in the day, before you guys were even born, right? The founder I think he rented the Apollo 13 DVD and he left it in his car. It was like a month later, he was cleaning out his car. He comes across the DVD. And he's like, oh man, like I owe Blockbuster like $200 in late fees. He's like, this is the stupidest thing. At the time, Blockbuster made 70% of their revenue from late fees. He's like, there's gotta be a better way. And he had this crazy idea. What if we take the DVD and mail it to people and just assume that they're just gonna sit on it like I do with mine, and they just pay a monthly subscription fee. But he could have raised the money, he could have launched it, spent money on production personnel, only to find out that the US Postal Service breaks every DVD that goes through the mail. So early on, as he identified one of these key risks, he's like, I wonder if we could mail a DVD for like 34 cents with like minimal packaging. So he performs the experiment. He takes the DVD, puts it in an envelope, no packaging, drops it in the mail. 2 days later, it shows up at his house and it's not broken. It's like, it works, right? This is an example of a small experiment identifying a risk that could totally eliminate it as a viable company and just finding out that it actually works. Is that a good example? Okay, other questions on this? I want to let you guys know early on, like where you are right now in your life, you're here, right? There is so much risk as I look at each of you. Like you're about to like get a really worthless degree. You're about to marry the wrong person. You're about to move to like St. George. Oh, sorry, Mark. There are tons and tons of issues, right? If you could somehow identify these and be like, okay, what could I do to eliminate all these bad potential risks? As risk goes down, your value goes way, way up, right? Like, not to get all religious on you guys, but your number one risk right now is probably sin. I would just eliminate that and be like, you know what? I'm going to cut that out. Not going to do that. Value is going to go way up and set you on a totally different path. Okay, I feel like I've said too much. Any comments?
What's some other early risks?
Like risks. I think your friends, the people like that you really like and you hang out with, I would really reconsider these people. I mean, I'm sure they're nice people, right? But I would really think about who can I like associate with? Who could I learn from? Who could I help? Like, it turns out these relationships, as Mark talked about, that you're making, they're much, much more valuable than you can imagine. Okay, myth number 4. Sales fixes everything. You hear this all the time. Things are not going well. And we're just like, oh, we'll just generate more sales. The truth is most ventures don't die because of sales, they die because of cash flow. So it's not because they stopped selling. So if you can understand the cycle of cash, this is really critical. This is a cash flow curve. I do not know why they don't teach this in accounting. You actually have to go to your accountant and show them how to do this because they're not taught. But you basically look at the free cash flow of the company on a cumulative basis. And most ventures you start off negative. You're investing into your company. You hit this point of cash flow positive. You're still negative, but you continue to generate cash flow. Then we hit break even, and then we see positive cash flow. And what you really want to do is find those companies or investments where you can minimize the initial investment, but also maximize the return. And you'll hear about things like burn rate, like what's the burn rate of a company? That's basically how much money they're burning through every month. And on a cumulative basis, it could really add up. But the plan here is you could look at different business models, look at different cash flows, and then decide, okay, this is the one we want to invest in. Just looking at these two, business model A and business model B, which of these is the better business model? A. Why do you say A? It's growing more. So you like A, but we had to invest 500,000 versus 200,000. Is that good or bad? Yes.
Is there much of a profit from that? Because business model B, you're only spending 200,000, and the other one you're spending 500,000. But from what it shows on the graph, they're both peaking out about that same point. So, is there much of a difference between the profit between the two?
Yeah, that's a good point. So really, it's all about the area under the curve. This is your future cumulative cash flow. So if you wanted to look at your return on investment, you look at the area under the curve here, that's negative, versus the area under the curve going forward. But you are right about Model A. If that path continues, the area under Model A will be much, much bigger than Model B. But why would we want to go with Model B? Why would we want to go $200,000 versus $500,000? Yes.
There's less risk involved.
Okay. Yeah. We usually miss our targets, but if we're only over a little 200,000 versus 500,000. Yeah, you had a comment?
Yeah, I was going to just think you can see they broke even at the 15-month mark, total was 18 months. So there we have that 3-month advantage. Plus, I don't know how to explain it, but you don't exactly need to be the big, that's a profitable business right there. You don't need to have
yeah. Yeah, if we could find a way to get in and have a successful venture with only 200,000 versus 500,000, lower risk, similar returns, and you're right, we do hit break even sooner. I remember with our company, our first one, the concrete business, I was burning through about 500,000 to 600,000 every month, just deeper and deeper into the hole. And we were tracking cash flow almost on a daily basis. And when we finally hit cash flow positive, this was a huge deal. Our investors were happy. They had a convertible note that switched to equity. The employees were happy because they got to vest in their stock options. And we threw a big, huge party. We brought in catering. We fed everyone. And that day, our cash flow went negative again, a little bit, right? But we soon came back, right? But this was a big deal. Knowing when we hit cash flow positive, that meant there was a future for the company. So, the last myth, my favorite one, you hear this a lot, never partner with anyone. Never give up a slice of equity. Always keep it to yourself. This is terrible advice. Most successful ventures are based on a small but disciplined team of individuals. These are people who are willing to share ownership, they're willing to share the burden, and they also share the benefit. My point here is if you're not willing to share your equity in your venture with anyone, why should anyone be willing to share with you? And this chance you have to build something that's of value, to share with your employees, share with your partners, this turns out to be really, really valuable, and it'll drive your people like nothing else. When they know they have a sliver of equity in your company, that every good decision is going to help benefit them, they think like owners. They stop thinking like employees.
Jason, I've got a question now. We may hear from other entrepreneurs this semester who tell us exactly never partner with anyone. This is a decision they've made.
Yeah.
So Have you had a bad experience with a partner? What have you learned from that that's helped you, do that better?
Yeah. Yes. Partnering with the right person is like really important. They say the only track record worse on marriages is business partners, which is probably a good reason not to marry your business partner. But if someone comes in here and says, never do it, I would just say, hey, let's get Jason on the phone. I'll jump on the call right here in the middle of the lecture. I'll be like, you're dead wrong. But I think it's a difference of opinion. Like, it is true. If you choose the wrong partner, yeah, things could go badly. My experience is, if you're willing to share in the future of the company, it just changes the mindset of everyone. It's super valuable. 2 minutes. Okay, perfect. I want to talk briefly about our first company in Santa Barbara. And the big thing I learned from this was you need 3 things. You need someone who can make it, someone who can sell it, and someone who can collect it. And I learned this the hard way. We had a proprietary mix design for high-strength concrete. We went into MGM's office. We met with Bobby Baldwin, these billionaires who are building this obscene MGM City Center. I think they were putting in $500 million, and Dubai World was putting in $500 million. But anyway, they were going to pour a lot of concrete, and we could help them save a lot of money. So we went down there. It was just a small group of us as engineers. We tested our concrete. It was kind of like Ocean's 11, only there was like 3 of us. And we set up our testing site right between the Monte Carlo, the MGM Grand City Center, the future site, and the New York. We poured our concrete. We tested it. We had like these phenomenal results. Like, no one could believe it. I mean, even the local guys who were pouring our concrete, they couldn't believe the quality, the consistency, the high strength. And we lost the bid. We had to share our mix design with the local contractors, and they basically stole it. They went back to MGM, and they're like, hey, you don't need to hire these guys. We've got their mix design. We can use it. So we didn't have a patent yet. We totally missed out on the opportunity. We went back to Santa Barbara, kind of looked with our head in our hands, and we told the story to a venture capital firm, and they loved it. They were like, this is awesome. Like, okay, tell us again, exactly how do you get this high strength concrete? And we're like, well, we use less cement. And they're like, did you know that cement is one of the major producers of CO2 in the world? And we're like, no, and we don't care. And they're like, we could totally spin this as a green product. I'm like, I don't know what that means. And they basically laid out this whole new plan. This was a Pacific Capital Group out of Beverly Hills. And this is what I mean about partnering with the right people. These guys understood the market. It took time, but they finally understood the technology, and they knew how to sell it. And before I knew it, we were sitting in front of architects, the New York Port Authority. We were talking about plans for the Freedom Tower in New York, probably one of the most important buildings in the last 100 years. And part of what Pacific Capital did, to their credit, was they put together this video, basically marketing the product, how it worked. And once we had this as our kind of like pilot, I would say, like our example of the technology, we had all these other companies lined up. They actually spec'd our product into the construction designs. Every time I go to New York now, I take an Uber downtown to the former site of the Twin Towers. I just go down there. I just feel my concrete. I just want to touch it, right? Like being a part of this was like so inspiring as a structural engineer, but it would have never happened without the partners that we had. Let me just wrap up. I started off talking about my startups. This is them today. And I just want to let you know that greatness happens in small places where you least expect it. And as a kid growing up in Southeast Idaho, entrepreneurship was like the last thing on my radar. I just wished I'd had an experience to be exposed to some of these things a little bit sooner. I'm so glad you guys have an opportunity like this, especially with Russ and the people he'll bring in to talk to you. please take the chance to like talk to these entrepreneurs, pick their brains, ask them questions. I've got a whole stack of business cards, so I'm happy to like hand you one, shake your hand, and anything I can do to be of help to you. I know Mark feels the same. Just want you to know that there's a bright future out there, and I want to thank you for your time. Any questions? Yes.
So the thing you just showed us.
Yeah.
Would you say that startup succeeded because of the marketing?
I think so. I think if we just kept it focused on our plans to just optimize concrete, it would have never gotten out to the masses. You know, we were going after individual batch plants trying to sell it and not having a lot of success. But when the architects saw the value and they spec'd it into an overall project, I mean, yeah. So without them and their marketing and most importantly, their network, I don't think we would have ever gotten there. Good. Any other questions? Yes.
How did you get the idea for that?
Oh man, I was in the lab with like Mark. I spent 2 years working on a master's in advanced composites and concrete. I was up to my elbows in concrete like every day, working on mixed designs. We had really smart people at the company with PhDs in civil engineering. But one thing they don't tell you about concrete is you have to test every single one of these cylinders, and you put these sulfur caps on them. And I don't know if you smelled like burnt sulfur, but after being in the lab for 6 hours, I would come home and I would smell like hell itself. And my wife would be like, "Don't you dare come into this apartment. You're gonna like take your clothes off at the door," right? Like I would say it was 2 years of like suffering and torture. Yes.
What's the concrete like made out of? Is it just a thinner consistency or?
It's a mixed design that basically allows you to get the tiniest, smallest, we call it interstitial spacing. You really focus on the weakest component, which is really that cement slurry between your gravel and your sand. We did have some admixtures to help with the strength, but it was really about monitoring the mixed design and having the equipment in place where you could monitor for changes in moisture, temperature, and adjust the mix on site. Yes?
Is it easier to like finish concrete and
Yeah, it just has a really high slump. It's really easy. It flows. And you know, one of your challenges when you're trying to get high strength concrete is you've got this huge aggregate flowing between all of the rebar, and this would just flow like butter, like in everything. Yes?
Do you still get profit from concrete?
I don't. We sold the company 2007 to the same venture capital group. Once they saw how successful it was, they bought it out, and that's when I got a call from BYU asking if I wanted to teach. So we sold it. I went to BYU for like 15 years, and now I'm back. I should add, we've got multiple investments here in Utah. We've got a packaging facility in Richfield, and so I'm always looking for marketing talent, production talent. I really can't turn this into a hiring pitch, can I?
Talk about your company
Oh, are we sure on time? Do we still have time?
Yeah, like 30 seconds.
30 seconds. I've got a card. It's one of our companies. It's called diatomaceousearth.com. We mine it, process it, package it. We sell anywhere between $10,000 to $20,000 a day on Amazon. Like Amazon is like our huge market. And so yeah, I need local talent, local help. So I'm happy to talk about that as well. And overall, I just want to say thanks again. Appreciate your time.
Thanks, Jason.
Yeah.